My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll be with my friends. I'm just trying to make you some money. It's my job. It's not just to entertain, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. All right, we've had a big run from the second week of June, including today. Dow gained 151 points. S&P climbed 0.40%. NASDAQ advanced 0.62%.
All aboard!
And a lot of this has to do with excess negativity. At the lows 2 months ago, the market had fallen 20%, and tons of experts were warning about much higher oil prices, much higher interest rates, and, of course, much lower stock prices. Just when oil peaked, just when interest rates peaked, and just when stocks bottomed. Now, you'd think the rampant pessimism would stop now that the market spent 2 months rebounding like crazy. But the bears, they keep doubling down. Today, the market got hit hard at the open because we had lower oil prices and reports of weakness in China. But then we had a sharp rally off the lows as Wall Street realized that lower oil and a slowdown in China are both positives, not negatives. As I pointed out this morning on Squawk on the Street, the weak opening made no sense whatsoever. Lower oil is good for the consumer, and it's anti-inflationary, which means the Fed has less reason to strangle the living daylights out of the economy. As for China, any softness there is actually fabulous in the news of inflation. Why? Because China's the marginal buyer of pretty much all raw goods. We need them to order less stuff. We need their government to tap out its resources trying to keep their drowning real estate market afloat. You want gas prices to be headed lower? You better pray the Chinese economy stays stagnant from here. So how could the market be so stupid as to sell off on that news this morning? Simple. Like every point since the bottom in mid-June, the bears just don't know how to quit. Oh, and let's not forget, unlike Europe, if the Chinese economy collapses, it won't bring our banks down with it because they don't really let us bank over there. I'm never worried about China getting so weak it causes global devastation because their authoritarian government can and will resuscitate the economy at gunpoint. With that in mind, let's turn to the game plan for the rest of the week. Now, normally, I like to go chronologically. I like to start, say, on Monday, which is, a very good place to start. Kind of like Sound of Music. All right, but this week I'm breaking form and jumping right to Wednesday because that's when we get the Fed minutes. These minutes are huge because they're going to tell us whether the Fed's going to flatten us with endless rate hikes or if there's some feeling that they can just wait and see or just do 50 basis points now that they've hit us with 2 triple rate whammies in a row. The latter would be very bullish. Just keep in mind these minutes are from late July when it wasn't as obvious that inflation has peaked. But, look, we know peak doesn't mean down. It just means peak. Now, before I get into the corporate news from the tail end of the earnings season, I need to address the housing start figures that come out tomorrow morning, because these are very significant. We need a huge number of housing starts because some home prices are sky high. They're up huge from 2 years ago, and the best way to solve that is by overbuilding. Not if you're a home builder, but for everybody else. Remember, this is an inventory recession. We need to see a glut of homes to roll back the pain of exorbitant rents as they compete for the same customer. I know homebuilder confidence has already fallen hard. We got those numbers today. But we've had a 2-year real estate boom, and the response to that is almost always overbuilding. It's what Jay Powell is counting on. Wednesday morning, we get retail sales, and that's also very, very important because we got to find out if the consumers finally stop buying willy-nilly. We also have to see the end of aggressive borrowing for goods. We heard that from Best Buy. Only way inflation can keep coming down is to stop the endless buying by the consumer. That said, as usual, I think we'll get our best intel from individual companies about the buying, not this big picture macro stuff. I always like the earnings progression this week because we have Walmart and Home Depot tomorrow, followed by Target and Lowe's on Wednesday. For the longest time, Home Depot was better than Lowe's, and Walmart was better than Target. Now Home Depot is better for professionals and Lowe's is better for do-it-yourselfers. To me, that means own Home Depot and avoid Lowe's simply because contractors are doing much better than the consumer side right at this point in the cycle. As for Target versus Walmart, Target's doing better because they took a gigantic inventory charge in June and then moved on, while Walmart's taken 2 charges on inventory and may still be stuck. I don't know. I know this, though. I don't think I'd want to be in either one of these. We solved this dilemma of having to have some retail exposure for the Charitable Trust by picking up Costco and Amazon instead. Now, it's been a very tough week for retail. Last week, Best Buy announced layoffs. Who knows how the now red-hot stock of Bed Bath & Beyond, up 23% today, yes, a meme stock, is going to get through this. Perhaps with a giant equity order, maybe an offering to sate the meme sanity. I made that term up. Meme sanity. The stores in the mall are dismal, and everyone's being hurt by theft, except Costco, which makes it difficult to steal, and Amazon because, well, I mean, it's an e-commerce play, except for Whole Foods. Some of these retailers are doing incredible things, but aside from some exceptional situations, you got to steer clear of them at this point in the business cycle. The book says, whatever the hedge fund book says, do not buy retail going into a recession. Lots of analysts don't like TJX here, and they seem to have a real good insight into how it's doing in Europe, where they're very big. My take, perhaps wait until the off-price chain reports on Wednesday morning and then do some buying, because TJX only makes out like a bandit whenever normal retailers need to dump their excess inventory like they're doing right now. Now, we also get to hear from Analog Devices, which is just a fantastic company. Now, I really like this one. Their chips are in prime demand. I'd own it. Now, speaking of own, we own Cisco for the Charitable Trust, which you can follow by joining the CNBC Investing Club. We're waiting for the orders to produce some upside after last quarter's gaffing. Cisco is so cheap, and there are a ton of negative analysts, so I expect the stock to spike if they say anything good at all. And if it's bad, I'm betting that stock holds here because of that bountiful yield. Thursday represents the best and worst of retail, and we get to hear from Kohl's, okay, that's a serial disappointer, and Estee Lauder, which is only a one-time disappointer. We need to see if Kohl's has any turn whatsoever, as it could easily slip into irrelevancy. As for Estee Lauder, they dropped the ball last time because of China. Now this time we need to find out if they're going to buy Tom Ford, the highest-end fashion company. It would be a big, not the man, but the company, okay? It would be a big change in strategy for the fragrance and skincare company. I'm not sure necessarily I like the deal, but then again, price is everything. I can't wait to hear what Applied Materials has to say Thursday night, because it's a premier semiconductor capital equipment maker. We want to be sure there are customers out there trying to solve the chip shortage. Sooner or later, they'll make a bundle from the CHIPS Act, but I'm hoping it's sooner. We need the chips. On Friday, Deere reports. Now, Davidson today, quality research firm, put out a terrific piece of research suggesting that while Deere has a full order book, maybe even more than full, they can't actually fill it because of supply chain problems. Aren't you tired of hearing that? I remain adamant that until we fix our supply chain woes, we'll be haunted by incessant price increases, and this inflation will continue to push the Fed in a direction that we don't want. We just want, look, remember, we don't mind the Fed raising rates. We just don't want it to keep raising rates hard and fast. Now, we also have Foot Locker, which used to be really important as an indicator of how Nike was doing, but now I think Foot Locker's fallen out of favor with Nike. These days, the shoe store is just an indicator of sneaker demand, and I have no desire to buy either right now. Here's the bottom line. This week is a referendum on the consumer, but please don't make it a referendum on China, which means nothing, or oil, which is mostly about Russia and nothing more. Let's start with questions with Chris in New York. Chris!
Hey, Jim. I currently own Chevron stock, and I have 2 questions. Where do you see oil prices going in the next 12 months? And do you think I should hold, sell, or buy additional Chevron stocks?
All right, we own Chevron for the Charitable Trust. Of course, you can follow how we're doing by joining the CNBC Investing Club. We happen to like Chevron. We have cut it when it's a little bit higher, but I will tell you this. I think oil kind of hangs right here. Makes a little stab at 100, makes a stab at 80, 80, 100, 80, 100, which is perfect for Chevron. They'll make a ton of money. All right, this week is a referendum on the consumer. But please don't make it a referendum on China, which means nothing, or oil, which is mostly about Russia, nothing more. On Mad Tonight, Getty Images has soared since coming public via SPAC. So what does the company have to do to make it go even higher? I'm not sure. I'm thinking of the details. Then, with the market beginning to favor the beaten-down tech stocks, are there any big names that could keep running into the rest of the year? I'm going off the charts to find out. And you called in on Boise Cascade and Chemocentrics, but I didn't know the name. So tonight I'm changing it up, turning in my homework on the 2 to see if either provides an enticing buy opportunity. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.